Our next guest isn't an academic. He's a practitioner, and he says the Fed doesn't have a silver bullet in its arsenal. Jim Caron is global head of interest rate strategy at Morgan Stanley and says in order for this form of stimulus to reach its full potential, it needs to be accompanied by solid fiscal policy. And by the way, as we're on the topic of semantics here with Operation Twist, you don't call it twist in the wind, you call it Operation Torque. We've got three separate names for it now. But tell me, Jim, in its simplest form, what it's likely to look like.
Well, as your other guests have said, that we think it's a maturity extension in the Fed's SOMA portfolio. And effectively what the Fed is trying to do, the dilemma is that they have to ease in a situation where they have a 0% Fed funds rate. Now, how do they do that? They've got to do that in unconventional terms. So by removing duration risk from the market, which is the same as extending duration in their portfolio, what they're effectively trying to do is reduce the risk premiums in other asset classes such that through a portfolio balance channel, investors take savings out of treasuries and put it into other credit-related asset classes, for example, and lower the borrowing costs and effectively ease financial conditions in the economy such that the broad-based effects of an Operation Torque or Twist or however you want to call it actually has some implications and could create some easier conditions.
Well, we saw a little bit of this, right, in the first rounds of monetary stimulus through quantitative easing, right? We saw risk assets like stocks, for instance, go much higher. But from the consumer's perspective, monetary stimulus has not really trickled down to them. We've talked a lot here on Fast Forward about mortgages and refis. Why isn't that happening? And would Operation Twist be different from, say, quantitative easing at this point?
Well, it is different than quantitative easing, and I think it's going to be less effective than quantitative easing. Number one, quantitative easing worked by increasing inflation expectations, so therefore asset reflation. Number two, it worked to weaken the dollar, which helped exports, which helps growth. And number three, it removed duration supply from the market. All Operation Torque does, as we call it, is removes duration supply from the market. Now, what we at Morgan Stanley are telling clients in terms of how effective we think this could be and what can we expect, what we have to remember is that we're in a delevering environment. And essentially what the Fed is trying to do, and they have a limited set of tools, is they're trying to create an environment where they create easier conditions. So the Fed is somewhat limited in terms of what they can do. Essentially, they're not trying to expand their balance sheet, so they can't do quantitative easing per se at this point. So this is one step out of many. And as I mentioned in a note that we sent out to clients today, that we do need good fiscal stimulus alongside of this. Then we can probably get some decent stimulus. But this in and of itself is not the solution.
Jim, I mentioned the Bloomberg survey we did of economists. 70%, 71% expect Operation Twist. Is it now priced into the markets? I mean, we've really seen credit spreads widen out quite dramatically over the last month and a half. Treasuries have rallied. You're saying that riskier assets now would look more attractive after Operation Twist. But it doesn't look like that's priced in just yet.
No, that's correct. And in fact, what I would say is that what's priced in the most is where market consensus believes the Fed will do their buying, which is mainly around the 8 to 10-year point on the U.S. Treasury curve. So we argue that those bonds have gotten relatively expensive. What we think, though, and it's slightly out of consensus, is that we argue that the Fed will actually buy longer durations of assets, maybe out to the 25 to 30-year point on the curve. Now, hopefully that removal of duration supply from the market in what we think is in a more efficient manner will, essentially, bring down those risk premiums of those other asset classes.
Looking forward, how many more arrows are in the Fed's quiver at this point? What else can they do? They can do Operation Twist at this point. We heard David Blanchflower. He was saying that he actually expects some form of quantitative easing as well tomorrow.
Yeah, well, I mean, first, what I would say is that the next step for them would be to cut interest on excess reserves, and we assign a probability that they may do that tomorrow. They could cut it by 10 to 15 basis points. Other things that they could do is they could more explicitly talk about a lower interest rate policy. They could even go back to something that they did post-World War II, which is to set a cap on interest rates. Now, in terms of quantitative easing, that could be down the road. That could be a mid-2012 scenario where the Fed is able to expand their balance sheet and actually go out and purchase assets. And I think that's a more effective form of easing in this environment. It's just going to be difficult for them to do since politically it's very difficult for them to expand their balance sheet at the time.
Jim, let's go back to those excess reserves and actually reducing the payout on that. That would likely impact banks. It's something I've heard in the past, but it doesn't seem to really be raising a lot of eyebrows. How would you quantify the impact of doing that?
Yeah, okay. So, essentially, what I think is taking place here is if you're cutting interest on excess reserves, you're essentially creating lower front-end interest rates when you're doing that. So what the Fed is trying to do is they're trying to counteract the selling that they plan to do in the front end of their portfolio, which could maybe increase interest rates. So therefore, by cutting interest on excess reserves, there's no demand destruction in the front end, and rates don't rise in the front end, therefore. So therefore, it's not a tightening. Now, as far as banks go, many people have made this argument. Most net interest margins by the banks are collected from 3 months to 5 years. Now, what Operation Torque is planning to do is extend durations out well beyond that, 10 years out to 30 years. So most of the buying and where we would expect interest rates to be lower than they otherwise would be would come out into the 10 to 30 year point. So I don't think it has a meaningful impact on net interest margins for banks necessarily.
All right, Jim, we got to leave it there. Do appreciate your insight, as always. Thanks for joining us. That was Jim Caron, Global Head of Interest Rate Strategies at Morgan Stanley.